800 credit score. You worked for it. You protected it. You made every payment on time. You kept your utilization low. You watched that number climb and felt genuinely good about it. And you should. 800 is excellent. Lenders love you. You get the best rates. Every door opens. But here's the question nobody asks when you're celebrating that score. Does an 800 credit score mean you're wealthy? Does it mean you're financially secure? Does it mean you've built anything real? Not necessarily. At all. Because your credit score measures one specific thing: how reliably you manage debt relationships with lenders. That's it. That's the entire measurement. It doesn't measure your net worth, doesn't measure your savings rate, doesn't measure your investment portfolio, doesn't measure your financial security or your wealth or your ability to survive a financial crisis. It measures your relationship with debt. And optimizing for a number that measures your relationship with debt while calling it financial health is one of the most subtle and expensive confusions in American personal finance. What the credit score actually measures. Let's be precise about what goes into your credit score because the components reveal exactly what the number represents. Payment history, 35% of your score. Have you paid your debts on time? This is the largest component. Rewards consistent debt repayment. Credit utilization, 30%. How much of your available credit are you using? Lower utilization scores better. This rewards having access to debt without using all of it. Length of credit history, 15%. How long have your accounts been open? Rewards long-term debt relationships. Credit mix, 10%. Do you have different types of debt? Credit cards, installment loans, mortgage? Rewards having multiple forms of debt simultaneously. New credit, 10%. Have you applied for new credit recently? Penalizes seeking new debt frequently. Add these together, and the picture is clear. Your credit score is a measure of how consistently you've been a reliable debt customer, how long you've maintained debt relationships, how many types of debt you carry, how responsibly you use available credit. Every component rewards behavior that benefits lenders, not behavior that builds your wealth. A person with no debt, no credit cards, no loans, no mortgage can have a poor or non-existent credit score despite having significant savings and investments, because they have no history of being a debt customer. A person with 4 credit cards, a car loan, and a mortgage, all paid on time, has an excellent credit score regardless of whether they have any savings or investments at all. The measurement system is designed by and for lenders. It measures what lenders care about. It has limited relationship to your actual financial health. The specific confusion this creates. The conflation of credit score with financial health produces specific, measurable financial damage. People open credit cards they don't need to build credit history. They make small purchases and pay them off to maintain utilization. They keep accounts open they'd otherwise close because closing accounts hurts length of credit history. All of this activity is optimizing for a lender metric at the cost of financial simplicity. People avoid paying off their mortgage early because they're concerned about losing the mortgage from their credit mix. They carry a debt that costs them 6% annually to maintain a component of a score they don't need to optimize. Most significantly, people treat a high credit score as evidence that they're doing well financially. They feel the same satisfaction from an 800 credit score that they'd feel from an $800,000 net worth. The feelings are similar. The financial realities are completely different. 800 credit score tells you that someone is an excellent debt manager. It tells you nothing about whether they have any wealth. The wealthy people who have mediocre credit scores. This is the data point that most clearly reveals the disconnect. Wealthy people who operate primarily in cash and investment assets, who have paid off their homes, carry no consumer debt, and don't regularly use credit products often have mediocre credit scores. Not because they've mismanaged debt, because they have minimal debt history to evaluate. A person with $2 million in investment accounts, a paid-off home, and no credit card debt might have a credit score in the 600 range because their accounts are old and inactive. A person with $50,000 in savings and $100,000 in debt across multiple credit products, all paid on time, might have a credit score above 750. A person with $2 million in investment accounts, a paid-off home, and no credit card debt might have a credit score in the 600 range because their accounts are old and inactive. A person with $50,000 in savings and $100,000 in debt across multiple credit products, all paid on time, might have a credit score above 750. The credit score ranks the second person higher. The second person is genuinely less financially secure. If the credit score measured financial health, these outcomes would be reversed. They're not reversed because the score doesn't measure financial health. It measures debt management. The person with more debt, managed responsibly, scores better by definition. What actually measures financial health? If credit score doesn't measure financial health, what does? Net worth, assets minus liabilities, what you own minus what you owe. This number tells you whether you've built anything real. A person with $500,000 in assets and $200,000 in debt has a net worth of $300,000. That's real. That's something. Savings rate, the percentage of income you're saving and investing consistently. This predicts wealth accumulation more reliably than almost any other single variable. Emergency fund adequacy, how many months of essential expenses do you have in accessible cash? This measures genuine financial resilience, the ability to absorb disruption without crisis. Debt to income ratio, what percentage of your monthly income goes to debt payments? High credit score with high debt to income ratio means you're managing debt well, but the debt is consuming income that could build wealth. Investment trajectory, are your invested assets growing at a rate that will produce the financial security you need by the time you need it? None of these appear in your credit score. All of them determine your actual financial security. The system that benefits from the confusion. The conflation of credit score with financial health is not accidental. The credit score system was created by lenders to serve lenders. FICO was developed to help banks assess loan risk. It has since been culturally positioned as a measure of personal financial responsibility. That repositioning benefits the lending industry enormously. When consumers believe a high credit score is the goal of good financial behavior, they optimize for debt management. They open accounts, carry balances, maintain credit relationships. All of that activity generates interest income, fee income, and ongoing customer relationships for financial institutions. A consumer who understands that genuine financial health is measured by net worth, savings rate, and investment trajectory might pay off all debt, close unnecessary accounts, and invest the freed cash flow. That consumer is financially healthier. They are less profitable for lenders. The credit score as a proxy for financial health keeps consumers focused on the metric that serves lenders rather than the metrics that serve their own wealth building. What to actually do with this information? This is not an argument that credit scores are irrelevant. They're not. If you need to borrow for a mortgage, for a business loan, for refinancing existing debt, your credit score determines your access and your rate. A good credit score saves real money on real transactions. Maintain a good credit score when you need access to credit. Pay on time. Keep utilization reasonable. Don't close old accounts for no reason. But stop treating the score as the objective. Stop optimizing for it beyond what's necessary for the borrowing you actually need. Stop feeling financially validated by a high credit score when the underlying financial picture may not support that validation. Measure the things that actually measure financial health. Calculate your net worth quarterly. Track your savings rate. Evaluate your investment trajectory. Understand your debt to income ratio. These numbers will tell you whether you're building something real. The credit score will tell you whether the banks like you. Banks liking you is useful for specific transactions. It is not the same as being financially secure. 800 credit score. It means you're an excellent debt customer. It means lenders trust you. It means you'll get good rates when you borrow. It does not mean you're wealthy. It does not mean you're financially secure. It does not mean you've built anything that will sustain you when you stop working. The confusion between credit score and financial health is not a minor semantic issue. It's a misdirection that keeps millions of Americans focused on a lender metric while their actual financial health net worth, savings rate, investment trajectory goes unmeasured and unoptimized. Know your credit score. Maintain it when you need it, but know your net worth more. Track your savings rate more carefully. Monitor your investment trajectory more closely, because the number that tells you whether you're actually winning financially is not the one the banks give you. It's the one you calculate yourself. From your assets minus your debts. That number doesn't care how the banks feel about you. It just tells you the truth.